The Ensemble podcast is intended for professional financial advisors. This content is created in partnership with our sponsor, Mason Stevens Limited, ABN 91141 447 207, AFSL 351578, and is limited to publicly available information. Before acting on any general advice, you should consider whether appropriate and obtain financial advice from a qualified financial advisor. Ensemble does not hold an AFS license and does not provide any financial advice or services or endorse any general advice. If a PDS or IM exists, you should obtain a copy and review it thoroughly before making a decision. The opinions expressed within the podcast are solely the individuals and do not reflect the opinions and beliefs of Mason Stevens.
Hello and welcome. My name is Brendon, Senior Financial Advisor at Moran Partners. Thank you for joining me on this deep dive into all things investment committees. We'll be talking about how to start one, how to make the most of this part of an advice business, and some of the best practices that go into making these work really well. It'll be a 4-part series where we hear from some of the leading minds about how to make investment committees work. Thanks for joining me.
This series is brought to you by Mason Stevens, a specialist wealth platform provider that focuses on managed account solutions. Recognised by Investment Trends in 2023 as the most improved platform and by Advisor Ratings in 2022 for best advisor support, Mason Stevens offers outsourced CIO services that complement their platform and managed account solutions. Established in 2010, Mason Stevens is led by some of Australia's most experienced finance and investment professionals.
Well, hello and welcome to this episode of the Ensemble podcast talking about investment committees. And here with me this morning we have Alex Hunt, partner at Moran Partners Financial Planning. Welcome, Alex. How are you?
I'm very well, thanks, Brendon. Thank you very much for having me on. Looking forward to it.
Me too. Alex, if you could you give us a quick little background on yourself and your practice?
Yeah, sure. So I guess it seems like it's come up pretty quickly, but it's now about 15 years I've been in financial services. Started when I was still at uni. I was a late person getting into uni, and when I first came for the interview here, I borrowed a shirt from my dad and started working one day a week while I was still finishing undergrad. And so I guess over the years, I haven't loved it. This is the only financial services place I've ever worked. So I started here and I haven't left. I've sort of made my way up through the ranks. Became an advisor, I think it must have been 2011, something like that, after a couple of years paraplanning. And have been here ever since through a few different iterations of the business over the journey. We became self-licensed in 2013 when we merged with another practice who was around the corner. And that was one of the best moves we ever made. It gave us a fair bit more, I guess, autonomy around what we were doing. And actually from a cost point of view at the time, I think we were more or less saving money compared to how some of the money that was going out the door for the licensees at the time. I think since that time, we probably ramped up our spending on other bits and pieces and, to go along with just the bare bones minimum. But we're predominantly a practice that's got a retiree client base. That's sort of a legacy of the business being running for probably 25 years in total. The older advisor, my other partner here in the business now he's been running for about 25 years. And so there's a lot of clients that have been with him for a very long time and have moved past that sort of transition phase well into the retirement phase. We actually have 3 other advisors other than myself. And we've sort of been gradually shifting younger as each advisor comes on, but that's sort of the natural progression. So I'd say
maybe reflecting the advisors, is that the case? Are the advisors younger as well? And attracting a younger client base? Yeah. That's right.
I think also, Paul Moran, the other partner in the business, he's kind of getting close to maxed out in terms of clients. Been seeing them for a long time. Still get a lot of referrals from existing clients, but he's sort of pretty much getting into capacity. So there's more room for the rest of us to take on those clients as well. But yes, as you say, the other advisors are all a little bit younger and therefore tend to attract some of the younger clients. So we do have a bit of a mix. There's a big focus on the retiree clients, which I'll sort of come back to, which feeds into the investment philosophy and the investment committee stuff later on. But that's not the only thing we do. We also have some of those sort of, I guess we typically call them accumulators, but those 35 to 55-year-olds in that sort of phase as well.
Nice. Oh, excellent. So, Alex, tell me about your sort of journey into investment committees. So this is a podcast focusing on the whole topic of how to put together and how to run investment committees. We're at episode 2. Most of our listeners, we imagine, are either firms who have maybe started down this path or thinking about going down this path and trying to get a bit more color around how to make this work really well in their business. Could you maybe take me to the start of where the investment committee journey began for you guys? Perhaps it was, I don't know, was it when you started and merged with that self-licensed firm? How did this all come about for you?
Yeah, sure. So it's an interesting way we got to the investment committee, and actually it all starts with really the investment philosophy, and I'm sure you've probably covered that. I know that's been covered really well inside the Ensemble platform, and I think you contributed to one of the articles, the white paper around building an investment philosophy. And so coming back to practically how that worked for us is we were looking at some research out of the US around managing downside equity risk in portfolios. Given that we had quite a large retiree client base, managing downside risk was as a priority along with maximizing return. But for a lot of retirees, a lot of those clients that had been through the what we call the GFC, but the financial crisis in 2007, 2008, when traditional portfolio wisdom said, just sit and hold and don't do anything, don't make any rash decisions. And then a lot of people tended to capitulate towards that, was it March 2008? And so we had a look at this, and we were the same, and all of our clients that held firm have recovered and did quite well, and anyone that sold out was, kicking themselves for a while. But we were looking at the research around managing that equity downside risk so that we could actually have something up our sleeve to be able to behaviorally reassure clients that we were taking some action, even if it wasn't necessarily to sell everything and go to cash.
Yeah.
Right. And so behaviorally, they really liked this idea that there was a mechanism that would help at least reduce the impact of these sorts of market shifts. So we were looking at dynamic asset allocation, and actually the paper we were looking at did say sell all of your equity allocation and go to cash, and go in and out based on some triggers. We adapted that and looked at a dynamic asset allocation strategy where we would adjust the equity allocation in a couple of different tranches. So when we hit one technical trigger, we would move some of the equity allocation. We either go in or out. And we also had some other rules in there that if we saw a 50% gain in equities in 1 year, we'd then take the conservative approach to take some profits. That was sort of starting to build some rules around that how we manage that portfolio. So That's what I mean when I talk about investment philosophy. We started to build this dynamic asset allocation investment philosophy, overlaid with a bit of a bias towards income. Mm-hmm. Trying to run that dynamic asset allocation in the practice with ROAs was an absolute nightmare.
I bet, yeah.
I don't know how many clients we had, but it was probably a couple of hundred across the practice that we were trying to implement this for. And so operationally, we had to make a decision that we would put aside a day at the end of the month, or we'd review the decision, the triggers at a particular day in the month. Then we'd have to write the ROAs. Then we'd have wait for them to come back, and then actually action them on an individual account basis. This is back in 2013, 2014. So
yeah, right. Okay.
A lot of the model portfolio functionality wasn't around back then. So this led us to look at what are the solutions we can look at here. And so managed discretionary account solution was the one that made the most sense. We could do all the trades in one go. We didn't need to write ROAs. It solved a lot of our problems. Now, when we went down the path of looking at how we were going to implement this, we didn't have a managed discretionary account license as part of our license. So we partnered with someone else who did, and they basically appointed us as the investment manager. But part of the requirements to be the investment manager on the MDA was to have an investment committee that met at least quarterly with an independent chair to review and make sure that we were running these in accordance with the charter that we also created as part of that process.
Right.
So that's really where it started. That's how we got to the investment committee being implemented, and it was really in partnership. It was really because we wanted to run these MDA portfolios, which has been a massive productivity improvement from a practice point of view.
Yeah, right. Okay, so this is sort of it kind of came out organically for you guys. You had an investment idea that sort of came to the forefront. You wanted to make sure it was implemented as best as possible, and an investment committee was kind of a necessary structure or a necessary overlay to make that idea work for for your advisors and for your clients ultimately as well?
Yeah, so I think we sort of didn't have the investment philosophy formalized, and not formalized, but we'd spoken about it a lot. We'd tested it. We'd got spreadsheets of back testing, so we had the ideas really in our head, but we didn't have it really written down or formalized anywhere. And so one of the great things about that starting the investment committee was it forced us to formalize it a little bit more and actually adhere and have a bit more intentionality about creating it and then managing the portfolios rather than I reckon we should do this month. Not that there was that, but we were trying to make a rules-based approach, but also that aligned with our kind of portfolio objectives and the values on there.
Yeah, and I imagine, without putting words in your mouth, that not everybody agrees with this from time to time. They might have a different perspective, and you need a way of coming to a decision, perhaps.
Yeah, exactly. I mean, that's part of the reason we have an independent chair, and we like to have an odd number of members, is so that somebody has the tie-breaking vote.
Yeah, you're going to have to come with a decision somewhere, and hopefully that person doesn't feel like they're to blame if it doesn't go right.
That's right. But I think also, when you're thinking about putting together an investment committee and thinking about who might be on there, you've got to be a little bit careful about egos and whether or not people's egos are going to get bruised if they're outvoted. We haven't really had that too often, but there's been times when there's been when that not everyone's views have aligned perfectly. Let's say.
Sure. Well, look, let's go there, because I'd be keen to sort of hear a little bit more about how that worked for you guys, because I mean, ultimately, who sits on this committee is a really fundamental part of its success, right? And there's a range of different perspectives, it would seem, about who should be on, whether you should have independent people, whether you should have, fund managers, paid consultants, or whether you keep it all internal. There seems to be a range of views about how this can be put together. So just sort of keeping things in order. You've gone and explored getting the MDA license or acquiring from the investment committee. So you're now getting set up and selecting who's on there. Maybe tell me a little bit more about the thought process that went into who should be on the committee and what sort of skills, attributes you're looking for.
Yeah, so for us, it was a little bit different. I think back in 2014, there wasn't as much pressure on us to have an external asset manager or asset consultant. We had our rules-based approach in the portfolio construction, which we'd sort of laid out as part of our application to run the MDA portfolios. We also did rely on a couple of tools, some input, so things like the Farrelly's asset allocation guide, if it's worth having a look at for anybody who's looking for some sort of input that might not necessarily be a full-time asset or an asset consultant. So at least something that gave us a guide or a reference point that we could then as a committee have a discussion about and making decisions about. But in terms of who should be on it, from our point of view, given that we already ran the portfolios this way, just in a very cumbersome manner, it was really just all the advisors in the practice plus an independent chair who was outside of the practice. Right. So that was all we started with. And that's actually really exactly how it runs today. We've gone down the path of looking at speaking to asset consultants, speaking to them around whether they actually come in and run the portfolios full time for us as well, and do the implementation side. Now we actually get some input, but they don't sit on the committee from the beta shares guys, from the economists and a couple of their economists. They dial into our investment committee and give us their views, but they don't sit there and have a vote on how we implement portfolios, either on the asset allocation or the investment selection side. So it's really just a guidance part from their point of view.
Right, and that's presumably a service that they offer as part of their offering broadly. Is that right?
Yeah, that's something that I think you'd have to speak to your BDM about, if over at Beta Shares, about how you would engage them in that capacity.
Yeah, sure. Okay. Yeah, interesting. All right. So you've kicked off with an independent chair and the advisors. How did you go around setting up the processes of what the investment committee is going to look at? And you mentioned a charter before. How did all this originate?
So when we started, it was with managedaccounts.com.au, which became Explore Wealth, which is now part of Hub. They gave us a lot of that framework to begin with, to sort of go through that process. So we looked at, we adapted it for our own to match our own style, but we created the charter, and we also started with an agenda an agenda for each meeting that they gave us, which we've sort of really changed up along the way. But it's nothing too fancy. It's really just making sure that we're covering off on issues that are open that are still open from previous meetings, reviewing the minutes from the last meeting, portfolio performance against benchmarks, and buys and sells, any changes in the portfolio. So we're reviewing all the decisions that have been made. Usually it's kind of looking back, but we also then have a section on thematic tilts, given that we run dynamic asset allocation portfolios as well, and corporate actions and sort of all those sorts of things. So corporate actions, because we're dealing with it at an MDA level, we're looking at what are we doing on each of these particular corporate actions across the whole portfolio. We don't really individualize in that sense for clients in that service unless they have a specific request to. But so that the process really started from having a template of an agenda, and I'm happy to share our one with anyone if they would like to have a quick look at and see what it looks like. It is a bit more focused on that MDA side, but it certainly has the bones of an investment committee agenda that you can work with and tailor to your own needs.
Yeah, excellent. You mentioned before about the investment philosophy and how that sort of tied in with the committee. I'm curious to know, since you set up, it was quite a while ago, have you, as a committee, made any sort of updates, or what's the interaction between the sort of stated philosophy of the firm and the investment committee? Is that something that has evolved over time, or is it something that sort of stayed, reasonably foundational? How has that looked?
Yeah, it's actually probably stayed reasonably foundational. There's been updates, but nothing dramatic. There's been no dramatic shifts. It's sort of, we started with the portfolio objective in mind. As I said, given that we've got quite a large retiree base as a practice, we have two styles of portfolios. We have pension portfolios where we're biasing towards income to pay, creating cash flow to pay pensions typically. Then we have your more typical accumulation style growth portfolios. We only got 5. We got 3 income, 2 accumulation. That's enough. It covers pretty much all of the bases that we need for those model portfolio styles. There's always things that come up that sit a little bit differently from, people need individual or tailoring, but they're kind of our building blocks. And so we haven't really had, and the objective certainly hasn't changed. It's more just around, okay, maybe some of the portfolio construction rules have changed slightly with the times.
Right.
It's always had a dynamic asset allocation, which we adjust over time, but we, as opportunities arise. But we actually haven't really. We've done one strategic asset allocation update in that sort of 8-9 year period.
Yeah, right.
And even then, it was only relatively minor. It was just that, again, given that we've got an income focus in some of those portfolios, we bias a little bit heavier to Australian shares, or we get a bit more of dividend income and franking credits. But for the most part, it actually hasn't changed a whole lot. We did do a lot of direct equities early on. We do a lot less of them now. Just time and expertise is not really where we want to spend our time in that research and picking. But so we've got some other tools that we use to either help pick them, or we've bundled them up in sort of smart beta strategies.
Right, gotcha. So you're just going for those, or more broadly targeting those factors in the market that's easier and maybe more straightforward way to get exposure to.
Yeah.
Excellent. I'm curious to talk a little bit more about the members of the committee and how the members sort of interact with each other. You sort of said before about you got to watch people's egos, and advisors often tend to have them to some degree. But at the same time, you obviously don't want this to be something that everybody, just agrees with and it becomes a rubber stamp or a ticker box exercise. Can you talk to me a little bit more about how that balance has worked for you? And I don't know, what's hard about that? What's easy about getting that mix right within the committee itself?
Yeah, good question. So we typically just have all the advisors sit on the committee because we're a small firm, they're part of the firm, and they're more or less have clients invested in the way that we run the models. So it's not really, so from a selection point of view, you get in by default by being part of the practice.
Yeah.
But a couple of us do like playing devil's advocate, which, that, and we sort of figure that that's what the investment committee's for, because, the other partner in the business, Paul Moran's done a doctorate in behavioral finance. And so, yes, we're kind of aware of biases. And so I often question, is there too much confirmation bias if we all agree? So if we all agree, then everyone sort of looks at each other and says, hold on a minute, let's just say, what if we're wrong? We think we're right, but we might not be. So you're right. You don't want just a series of head nodding. Yep, everyone agrees. It's all, yep, we must be right. Yep, this is all good. What you want is a bit of debate, even if you end up agreeing, and even if your starting point's an agreement. But we always like to tease out some of the issues or challenges that we see in any of the changes we're making or potential changes we're not making. So I think that's always a bit of fun, and that's where you need to have a little bit of ego, because you want to actually have that argument. You want people to share their views, but you also have to be able to accept. You have to be able to accept the decision of the committee if you're not on the right side of it.
Yeah. So can you give me an example? Is there anything contentious that sort of comes to mind where, I don't know, is it usually around that asset allocation piece? Is it about, sort of economic logic about what might be happening in markets? Where does this sort of practically rear its head?
I think it is generally in times of market stress. So let's look at March 2020, the COVID spiral downwards. One of our core priorities in the portfolio is capital protection. So we probably went a little bit more defensive than we typically would, just on how bad the news was. And there was not necessarily agreement in the investment committee about that move on some of the portfolios. That was really on the income portfolios. It was to be, in that lead up, that February, March, we went defensive, more defensive than certainly than what we did on the accumulation portfolios. All right. And yes, there was a disagreement there. In the end, the committee decided that, and again, based on the feedback from clients from back in the GFC, that they would rather us do something than nothing. And so we made it. We did sell out of some equities at exactly the wrong time. In that time. Now, again, talking to clients after that, they were perfectly happy with the decision. We got no blowback on that. Right. But it's a point where the committee did not necessarily agree exactly on the right way to go. But in the end, we didn't lose any clients out of that.
Yeah, the reasons were sort of explained, and the communication went out, and yeah, I guess if people are happy with why you're making that decision, it goes a long way to helping stay on the course, right?
Yeah, well, I think, exactly right. Fear is a powerful motivator, and people were happy to hear from us and are happy to hear that some action was being taken, right? Yeah. Even if the committee didn't, as I said, didn't necessarily completely agree on it. Another one has actually just been on investment selection side, whether we've gone too overweight in some particular asset classes or not enough. That happens from time to time, but it's generally, we're talking about shifting a couple of percent here or there. It's not, it's certainly not a material disagreement, or generally we're able to pretty well align. But one thing, just I want to bring up is a few years ago, when we brought some new people into the investment committee, when we had some change in the advisors in the practice, is that we sort of challenged them that every meeting to come with an idea, right?
Okay.
Because I think what we didn't want was not necessarily passengers, but there are some strong personalities on the committee. And as I said, Paul and I like to play devil's advocate and argue with each other, even if we actually agree. And so sometimes we can dominate a little bit. And so rather than everyone just saying, yeah, you guys are right, or wrong, or whichever way we land, what we wanted was everyone to come with their own idea around whether or not there should be any action in the portfolio, or where they see an opportunity, or where they're worried about a risk, so that we actually have at least input from everyone, but also means that they feel a lot more involved, bigger part of the decision-making process, rather than just not passengers, passengers not the right word, but rather than just having to go with whatever we decide.
Sure. Okay. That sounds really good. I guess you can't just sort of coast along too much if you're going to be put on the spot about something.
Yeah, but also I think you need to develop the expertise, and it's a way for those people that were newer to the investment committee to be able to gain the experience, but also have some impact on the decision making. I don't know about you, Brendon, but I always feel like you never really quite, until you got skin in the game, until you're the one that's made the call, you don't quite feel the consequences. And it's a theoretical, yeah, I should have done that or would have done that, but it's a different story when you're the one bearing the consequences in a way.
Yeah, it's one thing to be in the crowd and watching the game on the pitch, but as soon as you step out there yourself, it takes a different dynamic.
Absolutely.
And what's worked well for you as far as that upskilling process, right? Because as far as being on an investment committee, there's really no finish line as far as expertise. Markets change all the time, and there's always plenty to learn. Have there been any sources of education that you've utilised or other people on your committee have utilised that you really liked, that you thought worked really well, or tell me how that looks for you guys?
Yeah, sure. So I think there's a few things we all read, which we all kind of like. So there's some commentary from people like Christopher Joy, which is always entertaining, David Bassanese. So there's a few people. So we don't tend to read everything. We find there's a few things few people we think are on the money or have some analytical view that goes a little bit deeper than others, that we can that resonates maybe a little bit more with us. So that's the first thing. And they're the kind of weekly things that you might skim. So find the things that resonate with you around how the world looks and how to help shape your view of the world in markets and economics terms. But then also, I really enjoy, I love the investment side of things. That's kind of the fun part of this job for me. I mean, the client-facing stuff, don't get me wrong, that's the really rewarding part. But, the other fun part is to learn about investment markets, investment performance, portfolio construction. So I usually attend a few of the Portfolio Construction Forum events each year, and I find those really valuable in exposing me to a lot of different people's analysis and forecasts and reads on what's happening, as well as other potential strategies that might feed into how we run the portfolio, how to make it a little bit better. So I think that's one of the more valuable ones. But yeah, I think there's a lot of they're the ones that I pick partly because of time as well. The portfolio construction, I'm happy to put aside a day or two, but it's certainly not. It's hard to get away for lots of little chunks of time sometimes as well. And also, I think you can be a bit more present and try and soak in as much as you can in those days when you're not trying to jump between tasks and other sort of meetings. But you're right.
Great, Graham Rich and the team do an excellent job over there for sure.
They do a fantastic job. I mean, I would love to do the CFA. It's on my list of things I'd love to do. That was probably the plan until Fascia came out and sort of had to. I was okay. I've still had to do one unit, and but sort of there was a little bit of a hold on that for a while, waiting to see what I was actually going to have to then go and complete. And then having children also got in the way of the study time because the free time has well and truly disappeared. But I'm hoping I get a little bit more of it back to sort of undertake some of that in the near future. But that's probably where I'd go next. But you're right. I don't think it ever ends. It's a labour of love for me.
Sure. And tell me a little bit more about how that time commitment has looked for you and your practice, because advisors' world is always pulled in a bunch of different directions. So when sort of zooming back to when you started the committee and maybe reflecting on where you're at now, how has that time commitment evolved? And maybe paint me a picture of what it might look like on an annual cycle today.
Right. So I talked a bit about what it looked like operationally at the start to implement changes. Now we can really implement a portfolio change across the whole practice in a matter of minutes. We tend to take a little bit longer just to double check that we're not putting anyone into negative cash. We can do that, but just to make sure that we're not leaving them too thin. So really, a couple of minutes from a portfolio action. and certainly for a rebalance as well to create the orders and then execute them. So we don't typically make huge changes throughout the year. They tend to be fairly small with probably an annual rebalance. We looked at doing it in a more frequent manner, but part of the reason we've gone for annual is to try and let your winners run a little bit. We like to think that our thesis is often take a little bit of time to play out. We often think we're right well before the market does, if we are. So we don't rebalance a whole lot. So there's not a huge time commitment in terms of actually implementing the changes operationally. The investment committee meets 4 times a year. We're probably an hour and a half meeting most of the time. That's quarterly. We produce performance update as well as commentary on that as part of those quarterly report pack that gets reviewed at the investment committee. And so that takes a little bit of time, but it's not too much. And then I guess there's the informal subcommittee meetings, which is really just us. It's an informal version of the investment committee where we often make a lot of decisions as we're going, rather than having to wait for the next quarter. We don't make big decisions intra-quarter. It's more around a couple of switches or, for example, waiting on the next rate rise or, currency might, one of the last ones we did was when the Aussie dollar hit 62 US cents and we switched into the hedge version of a international fund, so that sort of stuff that we don't wait for the committee to make that change because we sort of already talked about it at the last committee meeting. But we also do that inside of a Microsoft Teams channel, which is a good way for everyone to, first of all, to chat about it, see it, record it, and have that sort of audit trail in there that we can go back and look at in the committee as well. Right?
Okay, cool. And is that sort of broken down as part of your charter then, perhaps, that your head IC meeting is reviewing minor intra-quarter changes? Have you got some thresholds around what sort of decisions can be made at that level versus needs to sort of go up to the full IC and all that sort of thing?
It's probably not a bad thing to have, but we don't have that in the charter. Given we did this in 2014, we didn't have the tech tools that we have now. And we were all in the office full-time 5 days a week and would have still informal subcommittee meetings. And back then we used to sit the phone and the audio recorder on there, and I don't think anyone's ever listened to them again. But so that's where something like the Microsoft Teams channel or Slack or whatever you want to use, it works really well. But we haven't updated the charter to sort of reflect that. There isn't really a sort of a limit to what the subcommittee can do, a formal limit to what the subcommittee do. But given that we're all, other than the independent chair, we're all on the committee anyway, it hasn't really been a factor.
Alex, I'm curious to know a little bit more about how this has looked for you when engaging with new fund managers or investment partners. I think what appeals to a lot of advisors about having an IC is perhaps the structure that comes around making assessments for who might be included in the portfolio. I guess it also prevents your diary from being filled up with BDM meetings all day, every day. Can you tell me a little bit more about how that's looked for you guys in engaging with those new investment partners and how that looks?
Yeah, sure. So, I mean, we try and catch up with all of the investment managers in the portfolios at least once a year. We try and schedule those very close to the quarterly investment committee meetings. And at times in the past, we've sort of said, instead of the whole hour, you've got 15, 20 minutes because we just a bit short on time. But you're right. So the other side of it is having all the 4 advisors here on the investment committee. Is we want them all to be in the meeting so that we're all hearing the same thing, rather than sort of just meeting with 1 or 2. In terms of how we assess them, we don't have exactly a formal framework. However, it really comes back to the investment philosophy. And for things like, cost, asset allocation, active versus passive, what are those things that you prioritize, that we prioritize in terms of the portfolio construction and the investment philosophy, and how does the investment manager fit in with those, as well as looking at where do they serve a purpose in terms of creating the portfolio outcome that we're looking for. So is it diversification where we can sort of lower the volatility of the portfolio, where we still get where it doesn't compromise the return. Those sorts of things where we might look at an alternative manager, or are we looking at an Aussie equity manager that is looking at harvesting franking credits versus just an index fund, for example. So it's really trying to align which investment managers are going to contribute to the portfolio outcome we're looking for. But we don't have a formal process that we go through. Part of it gets sucked into our analysis as to then what does the total cost of the portfolio look like, because we're not active or passive. We sit in more of a core satellite with a smart beta kind of core, smart beta passive core, and then the active sort of satellite approach. So so it's really around where are they going to fit in the portfolio. And are they better than the incumbents? Not better, but are they going to do a better job of meeting the portfolio objectives than the incumbents or not?
Sure. I'm curious to know, having run this for the better part of a decade now, do you sort of look back on this part of your practice and think, man, I really wish I did that differently? Or was there? Can you point to any decisions which you really would have changed at the time? And I don't really mean at a portfolio level, because, we can all go back and find the low points and find the high points and, pretend that we should have known what was going to happen next. But I just mean more in how you've made this sort of function of your business serve your advisors and help them serve their clients. Has there been any sort of mistakes where you go, we really we should have actually had more independent people earlier, or we should have had input from these other economists because that's been really helpful, and we didn't get around to do that, or we hired a very expensive asset consultant, we didn't really feel they added a whole lot of value. I don't know, like whatever it is. Is there anything that comes to mind when you sort of reflect back over your time?
Actually, no. I think with the efficiency pickup has been brilliant, and we've actually haven't really there haven't been really many decisions that we've made that haven't worked out well for us. We did, as I said, we looked at asset consultants, and even back then, someone was going to charge us 0.66 on the fund that they were managing under that low model portfolio, and we made the decision that was way too much. I think these days it's probably more like 0.1 is what you typically find in that sort of space. So that was a while ago, but so I think that's one of the ones where I think we got it right, where we thought, as appealing as their offer was outside of the cost outweighed the benefit. And in terms of other external parties, look, I guess maybe we probably, if we had have been able to engage them a little bit earlier, that might have led to some better decision making in the early days, rather than relying more on the newsletter style things. But being able to discuss and really get some insight from really very, very smart and talented people would have been beneficial. And I think, but the ability to ask questions and really dive into it is really valuable. So having someone you can bounce ideas off and say, hey, but what about this? A classic example is the last investment committee we were talking about. Talking about fixed income, and I had a question about something or other that had come up reading something, and that the consultant said, yeah, but it's the valuation's wrong. The idea is right, but the valuation's wrong. And so being able to have someone's expertise to sort of help direct and shape your views, as well as someone who lives and breathes it every day, is quite valuable. So I think that's probably the one I'd say is engaging people that you think have a great handle on things, and somewhat align with your views on how portfolios should be managed.
Yeah, and I guess someone that you can trust their input around, whatever challenge or shortcoming you might have internally, right? No business can know it all in-house. You got to be able to get some of that elsewhere.
I think that's a great point, because, as I said, but sometimes we think we're right, but we might not be. And having someone to challenge your view, or someone who can give a different contrasting point of view is really valuable, even if you don't necessarily change your decision, but at least you might be made aware of the opposite side to that, or the risk that you're missing.
Yeah, sure. And one thing on that, because I understand it's quite common for different fund managers to lend their expertise, and that can be great input into committees to sort of round out the expertise within the group. From a conflicts position, where do you draw the lines around sort of managing that for the committee? Because it gets potentially sticky, right?
Yeah. So we don't disclose to the guys at Beta Shares what's in the portfolio, and they don't have any input on the investment selection. So there's no direct conflict in that sense where they're saying you should be in this, and it's really more at an asset allocation level. And even, I suppose, on the fixed income side, it goes a little bit into the sub-asset classes around how we manage that. But you raise a good point, especially when you've got someone with a barrow to push who's providing some advice. And I think we've tried to manage that the best we can by sort of at least having that little bit of separation and not having not giving them a seat at the table, right?
Yeah.
To be able to either select investments or vote on the outcomes. It's really just a matter of providing an update and guidance. But yeah, in that instance, where you have a fund manager in there, that's where you've got to be a little bit careful, I suppose. But I think there are a few asset consultants that are removed from the fund management process that are able to at least give you a balanced view.
Yeah, I think that's a spectrum, right? And everyone's going to figure out how to manage that themselves. And yeah, for you guys to take away the voting power and maybe remove them from the specifics about manager selection, then that works for you guys.
Look, you're right. There may be a conflict, but you know what? Sometimes that conflict might be in sort of name only. You might still be getting a fantastic outcome for both your clients and your business, and by partnering with a fund manager. And okay, sure, maybe there's a conflict that you were required to use one or multiple of their products, but I don't necessarily think that will always make a terrible result for the clients. So there's certainly still some benefit there, and I think as long as you're upfront about that. Say, yeah, we've partnered with this manager or this asset, this asset manager, to provide this sort of a service, which we wouldn't be able to provide otherwise, or we would have to provide at a much greater cost. So I think as long as you're aware of it and you can rationalize it, and I don't think it's always a terrible thing.
Yeah, interesting. I'm curious to know as well, Alex, as we sort of draw to a close, is there any advice that you'd give to your 2013 self? Firstly, and say, is there anything that you should think about ahead of sort of going down this path, which I know we've sort of already covered, but and also secondly to that, what advice would you give someone who's sort of starting the journey, or maybe might be on the fence about whether or not this is something they want to do at all?
Ooh, good question. I think, what advice would I give myself nearly 10 years ago? Lean on someone for a really good agenda for the investment committee meeting if you're looking to start that up, because you want to make sure that you're covering off all the bases. Find some good asset consultants or some sort of input that you like and trust, or have faith in. And if you can find the people at a reasonable cost, get them involved. Find someone who doesn't always agree with you, and you can have that open discussion without having hurt feelings. And really, really bed down your investment philosophy. I don't think I can stress that enough, that everything that you do at the committee level really comes back to what are you trying to achieve, and the investment philosophy is a way that you can refer back to, and everyone can really have a say in, or at least understand the decision we're making relate back to this sort of, I would say, formalize it in a document. And there's a few tools around that are really useful in actually helping you articulate that sort of thing. So they'd be my top tips. If you're thinking about doing it, I think you've got to ask, why are you doing it? Are you, for us, it was all about the efficiency piece. And so if you're not going to run model portfolios, but you just want to have a consistent view across the practice around how portfolios should look, which I think has probably been done at licensee level, in the past, where licensees sort of mandated this is our strict, our risk profile and strategic asset allocation.
Yeah.
But I think if you want to have a bit more control and actually impart a bit more of your own investment knowledge or expertise or input, then this is a way to keep it a bit more consistent across advisors in the practice. And yeah, I think you can have a bit more faith that all portfolios will look more or less the same or similar. And especially, at a model portfolio level, it makes it much easier come review time to know what's in someone's portfolio. So, I think that all relates back to the investment committee part for us.
Yeah, and like you say, it's the efficiency of getting those best ideas implemented and executed in someone's portfolio as quickly as possible, right?
Yeah. One other thing I just sort of mention is have a think about the tools you want to use to actually implement it and run it. So, if you're going to run model portfolios, you're going to run these asset allocation models for, even if they're not model portfolios, but you sort of have a view on what a conservative or a moderate portfolio looks like. Have some sort of repository or some place where you can stick it and run reports on it. And, there's a few tools that we've used over the years that we've tried, things like Morningstar Direct, FE Analytics and Lonsec iRate, and just work out which one suits you, which research house you like, because that'll also play a bit of a part in which one you choose. But yeah, especially when it comes to, say, producing those reports, which are great communication tools with clients. They go out to clients directly. Those sorts of things that are a big time saver as well as giving you the kind of information that you need to make proper assessments on the decisions that you've made at the investment committee level.
And what tools work for you now?
So we've gone through a few of them, but at the moment we're using Lonsec iRate. So we track the portfolio performance in there, as well as, so we've got nearly 10 years of history now of portfolio returns, and actually we've been able to migrate across different tools with varying success as to how the data links from one to the other. But it's all just in terms of when you're looking at the portfolio breakdown and things. But
Alex, this is where you should have said to your earlier self, just use this tool.
But it didn't it didn't exist back then. Right. So many iterations.
Fair enough.
But yeah, if you can find a tool, that's one thing that's been, from my end anyway. I've been the secretary. I've done every role that we have in the investment committee and done all the back end, all the back end admin. So having a tool that is easy to use and easy to run reports from, that don't take too much work to customize and make it look like your own, and are reasonably accurate as well, is probably, you're right. That's probably the other tip I'd have. But yeah, we're using Lonsec iRate at the moment, and we can get a whole series of different data points and out of that tool, which gives us a bit of a view back on what's happened and how the decisions have gone that we've made. I loved using both FE Analytics and Morningstar Direct. There were some limitations in those, and cost was an issue as well. So it's about balancing how that looks. We're a relatively small operation, there being only 4 advisors, and some of the costs started to blow up a little bit with some of those when you're getting into the nitty gritty, when they're designed really for the big end of town fund managers.
Yeah. Well, Alex, it's been an absolute pleasure chatting. Thank you so much for sharing your wisdom and your experience in this space. We really appreciate your time.
Thanks, Brendon. Really happy to be here.